So all of a sudden, Bank of Canada is worried about the negative amortization, and they are now pushing banks to do something about it because this is going to hurt their profitability and the balance sheet going forward. At the same time, I was going through an article on Bloomberg where they interviewed a macro strategist from Desjardins, and he is predicting that the Bank of Canada will be forced to cut rates up to 2.5% in the next coming 2 years. And the reason why he's saying that is because there's a lot of fixed rate mortgages which are coming up for renewal, and pretty much 60% of outstanding mortgages are actually fixed rate mortgages, and they are going to come up for renewal. So people who have purchased properties or renewed mortgages back in 2020, 2021, when the rates were sub 2%, they are going to get a sticker shock when they renew their mortgages for 6.4, 6.5% going forward. And this is going to pretty much triple their monthly payments going forward. So based on this analysis, that macro strategist from Desjardins, I'm sharing his article on the screen as well. So he's saying that the Bank of Canada will be forced to cut rates by 2.5%. In this whole article, I've gone through that. I did not see a single word about the currency devaluation. So let's assume Bank of Canada is forced to do that. Okay, they have no other choice but to protect those homeowners being defaulted, or even if they don't get defaulted, they are going to start cutting consumption in terms of consumer spending. So if they have to triple their monthly payments, then they have to cover up that gap by something else. That could be other discretionary spending that they have to cut down in order to meet those higher payments. Let's assume it happens and Bank of Canada cut rates by 2.5%. What is going to happen with Canadian currency? Think about that. Right now, Canadian dollar is trading at 0.72 cents against the dollar, which is a 7-month low performance against USD. And the reason why this is happening is because there is an inflation expectation which is different in Canada versus in the US, and the rate hikes or staying rates for higher for longer, which is also different in US and Canada. So in Canada, our economy is much fragile compared to US, right? We know that. Our economy is pretty much a consumption-based economy, so we are service-based economy. We don't produce and manufacture a lot of goods and services compared to US. So comparatively, we are a much fragile economy than US. So inflation expectation is higher here than in the US. And when it comes to comparing the interest rate differential that I've been constantly talking about on my channel, that even the Bank of Canada keeps the rate at this level, and even if the Federal Reserve also keeps the rate at this level, the expectation of higher rates going forward, that is higher in the US compared to Canada, because Canada's economy is more fragile, it's more sensitive against the rate hike. So even if they keep the rate at this level and Bank and Federal Reserve raise 1 or 2 or 3 more rate hikes in the future, then the differential in terms of the interest rate between the Federal Reserve and the Bank of Canada is going to be much wider, which is going to put a lot of pressure on the Canadian currency. And when your currency gets devalued, then your imports becomes expensive. You actually pay more for importing the stuff, and we know that we import a lot of stuff from outside, and that will going to keep the inflationary pressure up. So even if Bank of Canada is forced to protect the residential home housing market to sustain that momentum and keep that bubble going forward, this is going to hit Canadian dollar big time, and this is going to make a big disaster in our economy going forwards. Because if policymakers have to fix things, they don't have to cut down rates, in my opinion. If they don't have to increase the rates anymore, but they have to keep the monetary conditions tighter so that they can slowly flush this whole system out of malinvestment and misallocation of resources. So what we have seen in the last 15 years, that was an anomaly. People think what we are seeing right now is an anomaly. If you look at a history of last 100 years. What we are seeing now is basically going back to normal, right? So the last 15 years of keeping the rates so low, running those programs like QE to stimulate the economy, that was not normal, guys. That was anomaly. Now we are going back to normal slowly. And if we stop that process prematurely, then this is going to kick the can further down the road, and then we are going back to this whole stimulus-based economy, which is going to give you a short-term boost, but of course in the long run this is going to be a disaster, because when you are not producing enough versus your spending, then of course it is going to hurt your economy, your currency going forward. These Keynesian economics principles, they work when you take debt and you produce more. Right now, this is all consumption. We're not producing enough, but we're taking more debt. I'm talking about country as a whole, nation as a whole. So that needs to change. Anyway, these are just my thoughts sharing with you, and you let me know what you think. Put your comments down below. If you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. Thank you.